without giving away trade secrets, are there any telltale signs that people should look out for, even if they're long and have got great hopes in a company or want to go short? Sort of language or financial ratios?
Absolutely. Both language and financial ratios are hugely insightful. And in terms of language, I think it's change of tone. Because, and this is where looking at some recent history can be very helpful. Look at how the change of tone of company management statements have evolved over the last couple of quarters or the last year. Because these people realise that everything they say will be poured over, and they also realise that if they come out and say X and Y happens, they could open themselves up to various legal redress or whatever. So actually looking at tone is so much more important. And this is why not just reading the corporate statements, but listening to things like webcasts or presentations. You get so much, all those little things about how people move or say or pause or whatever, that can be hugely helpful. So I'd say absolutely, that's certainly where it's helped me immensely over my investment career and continues to do so. In terms of ratios, the ultimate, I think if you're going to need to know 3 financial ratios in order to help you understand whether a company is good or bad, these would be the 3 I would use. The first would be free cash flow yield, because that helps to tell you whether a company is generating cash or not, or how much it is, how important it is. And then that allows you to then see what it's doing with that cash, which provides a lot of insight. I like EV/EBIT, because EV/EBIT brings together both earnings and debt, and debt is the real killer for companies in the sense if debt gets too high, that's when equity shareholders can get wiped out. And the third one would be internal management ownership, because there's nothing like putting your money where your mouth is.
Pricing power, niche playing, strong margins, discount to net asset value, barriers to entry. Are these concepts the building blocks of what goes to make a successful investment opportunity recovery situation, or is this just a sort of gross simplification?
Yeah, no, I think all of those factors are very important, because ultimately you're trying to look for a situation where you know more than 90% of the market does currently. And so what you're looking for are anomalies, misunderstandings, misinterpretations, which can be based on a sustainable view, which people don't think is going to happen at the moment or going to be continued for the moment. So I would focus in on strong positions, asset backing, of course, but ultimately, big picture, thematically, is this a growing or a stagnant or a depressed industry? And then trying to work out, does this company continue to have some kind of edge which will allow it to either sustain or make more profits and generate cash going forward? And then that allows you to sort of pigeonhole it in terms of your valuation profile. So it's a bit of it's very hard to get very defined rules on it, because there's an element of feel always with investment markets. But I think if you're asking those sorts of questions and trying to work out whether those themes and trends are sustainable or not, you're getting those building blocks to allow you to make a sensible decision or not.
So, any parting words of wisdom for our viewers?
So, the clear thing with investments is 2 things. You've got to enjoy it and you've got to be passionate about it. So you've got to put hard work in, and you've got to realise that it's not all about making gazillions of money very easily or quickly, because it isn't going to happen. If you think that's going to happen, go down to the casino, because I think the odds are probably better down there. So that'd be the first thing, be passionate and be thorough in your work. The second aspect is that, does it matter? And the answer is it does matter, but you've got to be not scared about the fact that you think that there's a huge barrier to everything you do here. Today, in today's world, the informational barriers are way, way less than they were. You can do a great job in getting out there and observing and seeing and feeling things yourself. If I was you, any investor out there, what they should do is pick up a copy of One Up on Wall Street by Peter Lynch, and you'll see for yourself. And I think it was a book that's hugely influenced the way I think, and I would always encourage even experienced investors to take a read of it and learn.
Chris Bailey, thank you very much for your time.
Thank you.
Really, well done.